Welcome back. It has been a busy week for investors. My strategy has changed. I'm going to be talking about the biggest risks in the market. I'm also going to be talking about the most important news regarding my biggest positions, what has happened, which stocks I'm actually selling or I've already sold, and which stocks I'm going to be buying in the next week or few weeks coming up. So stay tuned right to the end. Boohoo has seen some serious controversy this week. They are an online fashion retailer in the industry of fast fashion, so very similar to that of other companies like Primark, in which you would be paying for very cheap clothing, which would follow trends but not necessarily replicate the quality of it. However, this is a hit amongst younger people, or people of around my generation, so from around 16 to around 40, I think is their target. They've had some controversy, and what has happened is that they've been reported on for modern day slavery. And this is the fact that supposedly they were paying people in a factory that hadn't shut down, had continued working despite the lockdown and the regulations we've had in place. And they were not social distancing. They weren't trying to protect their employees against the pandemic. And they were paying them something like £3.50 an hour. And at 25 years old, minimum wage is £8.72 per hour. So this is a considerable drop. And so obviously this is a lot of news for the company and could be tragic. In which case you had seen in the last week or so that Boohoo had dropped from 400 pence per share to the low of 200 pence per share. And they've actually come back fighting. They are going to fight this. They are investigating the claims, although they're kind of misdirecting it in a way. Whereas it could be classed as modern day slavery. What they've done is they've said, right, well, we're going to look into this. Are we paying people above minimum wage? Rather than just looking at in certain areas where it could be conflict. It's something they definitely knew about. There's no way they didn't know that they were hiring these kind of employees, and the fact that they were effectively getting labour done cheaply in the heart of Leicester, which is interesting of all things, is a very diverse place in terms of culture. And in which case, supposedly, I'm going off of what I've heard, is that typically certain families of different heritages would force their wives or their daughters to go to work in these sweatshop or factory-like conditions, and in which case the money would be paid to the male rather than them themselves. However, Boohoo have managed to avoid this, or I believe that they are avoiding it by the fact that they are subcontractors. So they would hire out these contractors to run the factories, and then immediately it's not their liability, it's the contractor's liability. So it's the risk that they take. They could get done for it. But in fact, what has been spun on the news is the idea that it was Boohoo, when in reality, supposedly, it was one of their suppliers. But this has meant that 3 big retailers have dropped them, such as Next, ASOS, and something I don't know called Zalando. Regardless, this doesn't really impact much of their revenues, and I still think Boohoo will continue to grow. Yes, I do think that people in this age gap are very ethical. They are trying to think about the environment, everyone around, but also they can't afford to choose otherwise, right? A lot of people my age are spending it, and they're not so wise with money, but they're not going to be buying the most expensive clothing. You have got those people that buy more than they can afford, buying these like Supreme shirts for prices that just aren't worth it. I would personally rather buy cheaper clothes versus that of expensive clothes if they are of a similar quality. And so, despite the ethics being behind it, I simply would go with the cost. And I think this is a trend that's going to continue to happen. And in fact, the fundamentals of the company haven't changed whatsoever. I think it's very, very reliant on just shareholders panic selling, a short-term sell-off, which is one of the easiest ways to make money in the market. I've actually bought into a position. I'm going to talk more about this later on in the video. But there's also the idea that the higher-ups of Boohoo, one of them had ties to Primark, and Primark had done this in the past. So in the same sort of niche, except Primark is store-related, so high street. They don't really have an online retail service. And what they'd done is a very similar case, and people had forgotten about that, or maybe not forgotten, but still shopped there. And it was the same bloke that was involved between that. If you look a bit into it, I think he's personally going to be fine. And I'm going to speculate that they are going to try and improve shareholder returns. And whilst it's extremely unethical of me to be invested in this, I'm going to do so. And by 2023, if they reach certain share price goals or growth goals, then the CEOs are meant to be getting a cash bonus of something like 150 million. I think it's very likely that they're going to do everything they can to increase it. It does go against my morals a bit, but I'm happy to be there. I've bought in quite late, but I do think it's a good long-term hold, but it doesn't pay a dividend. So it is my first non-dividend stock, and I don't plan on continuing this trend. National Grid, the multinational utility company located in the UK and part of Northeast America. National Grid have seen their share price drop by 15% in the last 2 weeks. However, one of these reasons for about half of this would be the fact that they've passed the ex-dividend date, which is fair enough. But the second reason is due to two compounding factors. Ofgem, the energy regulator in the UK, proposed to halve the returns of the companies involved in this, which starts in April 2021 and goes on for the next 5 years after that. Effectively meaning that National Grid, SSE, their profits are going to be halved. And in which point this has raised red flags, because for the shareholders, how are we going to be paid a consistent, reliable and growing dividend? It's very likely that they would have to cut this, unless they change the deal, which they are in negotiations about, but I don't know how much power they have here. It's very likely it'd be cut and then grown again, at which point are you really growing a dividend if it's just been cut? But they've also been caught in more controversy, and whilst this sounds great at first, there's more to it. So what they've been doing is they've been trying to buy land near National Park of Snowdonia. And what they've done is they want to get rid of these pylons, which obviously would be visual. They don't look great in a national park or near the area. And so what they've proposed is that they'll get rid of the pylons and they'll put the electric underground. Great, right? Enhances the natural beauty of the area, perhaps brings more tourists in because it's a nicer looking scenery. However, what they've done is they've kind of screwed over the landowners and done compulsory purchase orders, which basically means that the owners of the land don't get a say in whether they can sell it or not. And in fact, they're just buying off them directly. And whilst I think there's not much to overrule this, I do think there is going to be considerable legal battles on this. I don't see why they couldn't have just bought the land temporarily, got rid of the pylons, and then owned the land underneath to build the tunnel. However, it's very complex legal issues, but I don't like the way they've approached it. And so with this in mind, with National Grid, I don't like this anymore. They're a utility stock, they're defensive. That's great if I was older. I think I'm a bit too young to be going the defensive route for now. And for me, I should really increase my risk. So in which case I've been changing my strategy. And what I've decided is that I'm going to sell out. I've sold out of National Grid. I've taken a loss. I had bought more into it this week, which is gutting. So I have lost more because I thought under £9 a share, it was a great deal. However, with this, it's so exposed to regulations and they don't really have control over this, and their dividend, I suspect would be at risk. If you've enjoyed the video so far and you're interested in my portfolio updates and progress in the UK market, then please consider subscribing as it is free. Thank you. Before getting into the biggest news of the week and then subsequently the biggest risk in the market right now, I'd like to talk about oil investments, such as my holding of Shell. I thought at first I was very bullish on the oil sector. I believed that we wouldn't be transitioning that fast away from oil, right? And I still think that's the case. However, I don't like being invested in these companies simply because there is so much politics related to it. Asset prices completely out of their control, and there's not much they can do to make profits from it. And so this means that crude oil by the barrel could increase or decrease regarding politics of other countries. Shell are in no way in control of this. When I first started investing, I thought, right, if I can get the best company in each major sector, I would have a great portfolio, I'd beat the market, and I'd be well diversified. But what I've realized is that, yes, it's great to spread your eggs out between the baskets, but it's even better to have your eggs in a few select baskets that offer diversification, but also don't expose you to sectors you don't like. I realised this with telecom. Telecom in the UK is a wreck. There's no point investing in it unless you're looking at things like Spirient Communications perhaps, or Artel Africa. I've not looked too much into this, but I don't like it. Energy, if you'd have invested in the last 20 years, you'd still be at a loss. And that's not even accounting for inflation, which you would have lost so much value of. I don't like energy. And yes, the new idea would be to move into renewable energy. And it is promising that these oil companies are proposing that, but it's not fast enough. I'm out of this sector. Yes, oil is still probably a very good long-term investment, but there's too much regulations, there's oil price wars, and it's not in the control of the company themselves to create these prices. I don't like it, and I've sold out and I've reinvested it elsewhere. A similar situation actually applies to that of my mining companies. Recently, you would have heard that I sold out Rio Tinto and then reinvested into Highland Gold Mining, which is a penny stock with Russian connections. So probably not a great thing, but I really love mining companies because they give you exposure to the asset prices. And typically when stocks fall or uncertainty or a recession is looming, gold prices rally. And that's what I wanted. I wanted a hedge in my portfolio so the stocks would drop, but this would go up. However, a portfolio of my size, it's not really that important. I feel that I have a better idea of just holding it in cash because the cash position ultimately would only lose such a little amount to inflation that it wouldn't matter so much. So I'm very likely I'm going to move out of this position. However, it's very likely that in the future, as I've built more equity, and in fact I've created a goal for myself, and that would be to have 100,000 of my overall net worth by the end of 2023, which may be a tough goal, but I think it's a good challenging goal to set. I think at that point, yes, I would like diversification. But what I'm going to do here is I'm going to time the market and I'm going to hopefully sell at a high. I'm going to look for gold prices to rally once more up to 8-year highs. And as the whole virus uncertainty is increasing again due to the increased amount of cases in the US, I think this to be very likely. But it also means that 20% of my overall investments of my portfolio are in the AIM market, which isn't as regulated by the Financial Conduct Authority and is a lot more risky. I don't want to stay into this, so I'm going to be moving out of it. This also allows me to build bigger positions in the companies I know and hopefully outperform that of the market in the future. And whilst, yes, this is probably a great holding to have and it'll probably see great returns, I just want to have a smaller pool of companies I know, I understand, and that can generate consistent returns. What I've done is National Grid, Shell, and well, hopefully Highland Gold Mining in the next week or so. I've sold out of these two, National Grid and Shell, and I've reinvested it into another company. I lost money on Shell, about 50 quid. It was down about 4 or 5%, and this was just before it dropped another 4%. So I'm quite glad I got out of that. I sold out of it and reinvested into Boohoo. Same with National Grid, I was down about 4 or 5%, lost about 25. And I'd reinvested into Boohoo at an effective low. I didn't get it anywhere near the bottom of the crash. I was a day out of it. I got it actually at quite a high. I bought at £2.96 and then subsequently the next day at £2.80, which sounds terrible, right? And if this stock is going to zero, then I'm going to lose a lot of money. Understood. I do see this as quite a long-term hold. I'm bullish on the company and it does seem like very high risk and it's that kind of get rich quick kind of thing. Worst comes worse, it might rally up to 350 pence per share and I could sell out, reinvest it into my other companies and I'd be happy. Or it could drop to zero and I lose around about £1,300, chalk it up as a mistake that I've done early in life before I have loads of tens of thousands of money invested in each individual stocks, and therefore I've made that mistake so I don't lose more money in the future. My average price on Boohoo currently is around £2.91. I will continue to add to this position slightly. I don't know how much more I'm going to go. If it dips further, then sure. However, the biggest news this week is the likes of Aviva. And if you'd have been following me on Twitter, you would have seen my post about it. So if you're interested in that, please consider following it. And what I'd mentioned is that Aviva's CEO, Maurice Tulloch, had left the company due to family health reasons, which is quite saddening in truth. I did like his visions and beliefs for the company and felt that he had great plans and he was really improving the company, at least from his predecessor. After he left, a new person had stepped up to the plate. And this woman, I think, can do a lot for the company. Mr. Tulloch's strategy for the company was fairly uncertain at times. He had firstly diversed a plan, right? His plan was to split the companies, right? Split it, become more efficient at what it is. But then he thought, you know what? No, I've done 3 months planning. Let's get rid of that. I'm going to develop the fundamentals of a company. Both of these are excellent strategies. He chose these, but he was uncertain as a whole. That leads to a high risk in the market. A lot of average investors typically buy at a high and sell at a low. And that sounds like a meme, a joke, right? But it is the case in a lot of situations. In fact, I've even done it. And there's no guarantee because I invested quite late into the pandemic due to the whole ISA swapping around. I only had an index fund at the time of the drop. There's no guarantee that come the next crash that I'm not going to sell out myself. And that's why I've developed myself a new strategy as part of my portfolio changing. And what I've decided to do is that I have a notepad here, and it's got all of my like random scribbles from loads of things. I'm not going to show it for too long because there's some stuff on there. As my portfolio has changed over the last few months, I'd scribble down things. But what I've decided to do is I'm going to write down why I'm investing in this certain company here and here. Right, so Boohoo, why am I investing in this company? I believe in the long-term growth of fast fashion. I think that online retail is a very strong spot to be in, and I think the demand is only going to increase. I think that at £2.90 a share, that's a very excellent price, and in the next 1 to 3 years, I could see it twofold by increasing by around 100% or more. In the past, very much picked these stocks and then thought, well, actually, it's not that good. Shell is a prime example of this. I've mentioned about my ideas around the energy sector, but they hadn't even grown their dividend in the last 5 years. I have a different set of boxes I like to tick now, and dividend growth, for instance, is one of the bigger factors in this. And what I'm saying is, well, there's better companies that I didn't know of before, but I know of now. And it makes me look uncertain, look like a trader. But I'm pretty sure this is a lot of things that beginner stock picker investors would do. And I'm hoping in the next few months to few years that I will consolidate the companies that I own and be certain about every single one, their future, their potential, why I'm invested in them, and have considerable amount of equities in these stocks, and then hopefully outperform the market in the future. That's my goal. So for the time being, do bear with me, right? I'm going to be moving around a lot, but I'm slowly finding these better investments and I'm getting happy with them. I'm going to aim for around 7 to 8 holdings, current amount of money, although I would really love to hold less. It's just, I can't bear to lose some of the ones I own. The woman taking over Aviva, however, is called Amanda Blanc. I don't know for certain. I'm going to say Amanda B. And she is widely known for the fact that when she took over AXA, which is an insurance company located in France and I think diversified across Europe. And they were a loss-making insurance company, and she managed to turn it around to the second strongest insurance firm in that region, which is extremely impressive and does present a lot for Aviva. And on this news of her becoming the CEO of Aviva, the stocks rallied around 5 to 6%, suggesting that the investors have got higher sentiment towards it. And a lot of people are speculating that she is going to make a bold move, such as radically split the company between separating the UK business from the global business, splitting the company between health and life insurance so they can focus on each individual sector. And I think this is a great idea. I'm going to be watching eagerly up until August. August is when we're going to find out more about it. I'm particularly interested in the dividend. If the company's management doesn't fall align with what I believe that they should be doing, I'm likely going to sell out, which sounds ridiculous as I think I've got like 2 or 3 holdings since the creation of the portfolio, but I think this is fair. My strategy is changing and adapting over this time period. Things change. The share price may rally if it doesn't go with what I am, whatever it is. I'm going to sell out. I'm going to reinvest it into another financial company, which I won't mention just yet, but I will talk about a lot in the future, as I do think it has potential, but it is quite overvalued at the moment, but I don't mind. You'd pay a premium for a wonderful company, right? And whilst I'm bullish that these changes can really bring a lot to the company of Aviva, I'm not bullish on the idea that the shares will do the same, and they've not really done much over their history. Whilst, yes, it looks like a great value play, how can I be sure that I've not fallen into a value trap as well? My top performer this week has actually been my house builder, Redrow. And I know I've spoken about this company a lot, even could be Redrow's biggest bull. They've managed to reclaw back share price. They had lost it quite a considerable amount last week because they were moving out of London, which again is short-term sell-off. And this short-term sell-off effectively means that people are selling for no real reason. Obviously, if it doesn't align with your strategy, then fair point. But I managed to buy more at this time, and now it is starting to rally again. And I do believe that this stock could twofold, perhaps threefold. I think that we can see 100%, 200% increase in the next 3 to 5 years, and I'm very bullish on this. And the fact that they've increased 9% over the last week is positive because I think the overall market has decreased. Not only are you holding a quality house building stock, but it gives me that diversification into the housing market, the property side of things. And because I don't own any properties at this current time of making this video, and likely not for the next 5 to 10 years, it makes sense why I have such a big holding that's invested in the housing market. And I'm very happy with this and the diversification it brings. Whilst I may not be adding to my amount of shares for a while now, I will look and hold this for a long time. And I think with the government changes and how they are offering a new stimulus plan of removing stamp duty, which you may have seen when buying or selling stocks on the stock market, stamp duty is a little bit different with housing, but it is on the purchase of a house. And so they've cleared that for properties under, I believe, 450,000, or for cheaper properties. And this means that they can prop up the housing market somewhat. And this means that obviously if people are more bullish on the housing market, then Redrow is likely to benefit. I'm up around 3.45%, sitting at a current equity of around £2,360. In the future, obviously this isn't going to be my biggest holding. I have other stocks that I prefer in that place. I'm just not going to add as much to it as time passes. However, what is a surprise is that Ashtead Group has actually fallen in the last week, and they've managed to drop something like 6 to 7% in the last 5 to 6 days. Incredible, because this company is such a great company to own, I believe, in my personal opinion. And I'm speculating as I can't find too much news on it. They're exposed heavily to the US market. And so I believe that because of this and the fact that the pandemic cases are increasing a lot, that perhaps this has put fear onto the stock price and that things could go back into lockdown in the US. And obviously with the uncertainty of who's going to be in the presidential election, such as Kanye going for president, they're going to have to look how to socially distance and work effectively. How can they rent out their products and still manage to keep business flowing? I'm likely going to buy more into this if I can sell more out of my other things and buy into it. As I said, I want this to probably be my 4th largest position in the portfolio. I'm very confident in the company, its future, its dividend growth, and what it can bring for me. What I've seen in the last few weeks, months, and likely a lot of investors have seen if they've invested longer than me for years, is that short-term sell-offs lead to a lot of gains to be made in the market. We've seen this with Boohoo. If you'd have sold off panicking, right, over the news that there was modern-day slavery, which was inflated by a news article, then you likely would have lost out big time. And whilst yes, ethical investments do matter, it also comes to the idea that if you'd have bought in at 200 pence per share, you would now nearly be up 50% already. However, whilst AIM obviously is a lot more risky and volatile than that of the 350, however, the issue is that investors will sell out in times of uncertainty. You need to truly believe in your companies, otherwise you're just going to lose money. With my strategy change, I'm planning to move my more defensive positions. Now that National Grid's gone, the only two I really have left are Unilever and Diageo. Basically, my idea is to hold 5% in each, which sounds like a lot for some people, but I don't plan on owning that many companies. 10% of my overall portfolio in consumer defensive stocks, reliable dividend income. I'm happy with that. I'm likely going to move some of the money out of Diageo because I am a bit overexposed to that one, even out the positions and then leave it. The rest of the money will be reinvested into the other stocks in the portfolio, in which Games Workshop, a position that is quite small in my portfolio at the moment, I'm going to make 30% of my total portfolio. And whilst they are dropping, I think they've dropped around 2.8% in the last week and they're going close to £80 per share, this is a sign of weakness. And with Games Workshop, you want to buy on every weakness as they typically seem to keep going. I would see this as a very similar stock growth to Tesla, but there's more thesis and reasons behind it. Whilst the brand isn't obviously as known as Tesla, it's getting bigger, it's getting a lot of exposure. Film makers want to use the Warhammer branch, games developers, but also the hobbyists, the ones that will continue to buy this, will also want to see buy the newest figurine that they can paint. However, the biggest risk in the market right now is you, us, the investors of the stock market, and what your plans are and what you plan to do. The biggest risk is uncertainty. If you don't know why you're invested in a company, what is to stop you from selling out the moment you have a 5% loss? At that point, maybe it's a good idea to look at your portfolio less, because I've found that if you're looking at your portfolios and the individual share prices by second, you're going to see that you're going to be trying to time the market rather than investing long term and holding these stocks. And we all know that time in the market is better than timing the market. This phrase has been said so many times. It still stands, and it's a big mistake that people, or at least I've been making over the last few weeks, for the average investor underperforming the market. My goal, beat the market, beat those fund managers. Stay tuned, as Tuesday at 4 p.m. I'm going to be doing my first stock analysis on the channel. This is the Ozbourne Foreman Show. Thank you for watching.